Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you, of course, help to make it actionable, understandable, and clear. What a week. What a show. 3 excellent articles revolving around one of our favorite topics, the almighty index fund. When it rains, it pours, and we had a tremendous deluge of articles that certainly could have made the show in any other week. But this week, you just get 3. And my producers are sticklers. They tell me to straight and narrow. So we are going to be looking at the Apollo chief economist, Mr. Torsten Slok, and his concerns about passive investing's growth. We then will look at, it was an excellent article, but the picture's even better. When boring became beautiful for stock market investors. It's a story about Mr. Jack Bogle, the founder of Vanguard. It's got a picture of him on a speedboat on the water in his old age. And then we close with a sad article in a sense, but really informative. Mr. Jonathan Clements, the longtime Wall Street Journal columnist, wound up passing away at 62. We look at some of the accomplishments in his life and what he did for the everyday investor. At the top, friend of the show sent me this. He's a Vanderbilt graduate. He knows who he is. Vanderbilt's undefeated, so a lot of those graduates are coming out of the woodwork. Mr. Torsten Slok, the Apollo chief economist, comes out and tells us that the amount of money in passive investing is growing, and there are consequences to this development. Let's do some definitional work. Passive investing, of course, being money that is invested via an index where you are, this is where they get the word passive, passively mimicking the holdings of the index. You're not actively deciding which stocks to buy and what amounts. You're letting the index determine it, and you are passively following that index. Well, what is this chief economist at Apollo? Apollo being the large asset manager that does private equity, private credit, secondaries, a bunch of ESG investing, lots and lots and lots of money that they manage. Here's what the economist says. He says, and he looks like his gaze is directed straight at the Robert Hunt Financial Market Update. He probably had us in mind as he wrote this. He said there are 3 consequences to this development of this increase of passive investing. Number 1, reduced market efficiency and price discovery. Number 2, increased market concentration and volatility. Number 3, growing correlation and systemic risk. I believe or else there's a 19-page paper he wrote that I skimmed, did not read for you, but I skimmed it just so we'd know. He has 2 pictures. One being the percentage of passive funds, ETFs and mutual funds from the year 2012 to present. It's grown from, get this, 25% to 55% of ETFs and mutual funds are now passive. They mimic the index. He also has, and I'm proud of him for this, he shows the active funds that lag their respective benchmarks, and he shows the atrocious results of active fund management, how they just get destroyed by the index, which you hear quite a bit from me. But let's talk about some of these concerns that he has. Number 1, he says there's reduced market efficiency and price discovery. Well, how so? How so? Let's keep in mind, where, listener, is this money coming from that's going to passive money investing? Where's it coming from? It's coming from people who used to actively invest. Where else could it come from? And how did these people invest? They either sat in their PJs, clicking a button, listening to Jim Cramer. Well, is that increasing market efficiency? No. Or they were just handing their money over to Mr. Active Manager at Big Bank ABC or Wealth Manager XYZ. Was that helping market efficiency? A little bit, maybe. They weren't doing that great a job, though. So I see this as a misnomer. Paradoxically, I argue that the market is becoming more efficient, and this is actually a Jack Bogle argument. The market is becoming more efficient on this current trajectory of increased passive investing. And why? How could that be? Isn't it the case that more active participants would create a more efficient market? No. Intelligent market participants, industrious active market participants, very well, they certainly do make our market efficient, but the dumb money, the retail money, the loose institutional money, when it throws in the towel and goes index, goes passive, the market becomes more efficient. Because who are the players left? Only the sharp, only the adept, only the learned, only those who are doing great work. Mr. Warren Buffett himself, he's an active investor. He participates in the market. He contributes to its efficiency. But they're the only ones that can stand at the end of the day, because the rest of these guys lose. Now, number 2, increased market concentration and volatility. This market concentration is not caused by index funds. Index funds are not price makers, they're price takers. So the great NVIDIA run-up, were index funds causing NVIDIA to become the largest company by market cap and creating more concentration in your index and my index? Was that an index fund? No, how could that be? Index funds don't make prices, they take prices. It's the investors who are bidding up the price of NVIDIA. The index is mimicking. So when Meta and Alphabet, Microsoft, all these folks, NVIDIA, who are the detractors, are saying, oh, that's increased market concentration, too much volatility, too much market. That's not the index. That's everyone else. The index is just parroting them. And then growing correlation and systemic risk. Now, I see from my view, this is my view, and I can appreciate this argument. If he's mentioned, if systemic risk is defined as having too much money in the hands of too few institutions, meaning BlackRock, Fidelity, Vanguard, I can listen to that. I can hear that argument, and I think it's a legitimate one. I don't have a great answer for it other than, guess what happens when people serve customers well, lower prices, and have the best products? They gain market share. So I don't lose a lot of sleep over that at night, because these companies are really well run and aren't taking a lot of capital risk on their balance sheets. They really shouldn't. Of course, who knows? Correlation, again, price taker, not a price maker. So oftentimes when these articles come out by these learned economists, I believe they mean well. Ultimately, though, and maybe though, ultimately, okay, if you force me to argue for the other side, fight for the enemy, I do think it's quite possible that at some market share level, the market price discovery becomes difficult. I don't know what that share is. We haven't hit it yet. Is it 95% passive, 5% active? Even then, it could still work. It could still function. Index funds would still be superior. But I could see why it could be a little, at some extreme, of course, it could be wonky. We're far from it. And you and I don't need to worry about it. The greatest risk in these articles is it somehow throws you for a loop. You're over there chopping wood, carrying water, doing exactly what you need to do, keeping those costs low, investing simple and time horizon long. And then Torsten Slock, the Apollo chief economist, begins to throw pebbles into your shoe and explain that there's systemic risk because of what you're doing. Don't worry. Just take the pebble out, keep walking on your way. Don't worry about it. And then a Wall Street Journal article by, this is Alan Sloan. Headline, when boring became beautiful for stock market investors. Subheadline, index funds were first considered nonsense. That nonsense now rules among many individual investors, hopefully you and me. He's talking about the past 50 years. Imagine that, past 50 years. He says index funds are probably the most enduring and transformative innovation for individual investors since mutual funds became available to them in 1928. Agreed. As you know, I go even further. In the 20th century, the semiconductor, antibiotics, and the index fund are the three greatest inventions. The index fund first made its debut in 1976. listen to how hard it was for them. Listen to this. The launch of the first index fund in 1976 was such a dog. The article explains that when Vanguard Group tried to raise money for it, Vanguard tried to raise $150 million from investors. They could only raise 11.3. That was not enough to buy 100 shares of each of the 500 stocks in the index. 50 years later, look where we are. It says, as of June 30th, index fund assets, again, you remember the previous article was talking about number of funds. That's the percentage of assets is 33.7 of total fund assets in the U.S. It's up 1.77. That's a big number. As of June 30th, what's now called the Vanguard 500 Index Fund and sister ETF have 1.5 trillion. That's trillion. And Vanguard's total stock market index has, an ETF has 1.9 trillion. So that's 50 years, pretty good run. There's an obsession with fees. This journalist had the courage to tell us that he remembers rolling his eyes when the first index fund was introduced. This journalist is 80 years old now, and he thought it was ridiculous. The expense ratio, drumroll please, bring the children and grandchildren into the living room on this one, because they need to realize how good they had it. We walked uphill in the snow to school to invest. Grandchildren, listen how good you have it. The expense ratio for an index fund in 1981 was 0.43% of assets. That's 10 times the current expense level for the equivalent fund. 0.43% in 1981. And by the way, that was the cheapest out there. It was egregious how difficult and expensive it was to invest in the past. Why is that? The article beautifully explains Vanguard is owned by the shareholders of the fund, not for profit-seeking outsiders. So as much as Vanguard wants its companies it owns in the index to produce profits, Vanguard itself does not produce profits. It is a mutual fund company, so it kept lowering fees. Others have joined the fray, Schwab, Fidelity, and BlackRock, which has been all to the good for you and for me. So the fees have dropped, but the journey was long and hard. So Mr. Alan Sloan makes a prediction at the end of this that I tend to agree. He says index funds are likely to keep taking market share from active funds as far as the eye can see. And remember, listener, on our previous article, we're not scared of Mr. Torsten Slock's predictions. Let's keep taking market share. We'll raise the siren. The RHF market update, I will shoot the flare gun. And when it's 98% passive and 2% active, this may become an active broadcast. We might be going long, NVIDIA, short, Meta. This will be the most active place in the universe. Until then, we're just going to keep winning. We're going to get tired of winning. And in closing, Jonathan Clements, who's a longtime Wall Street Journal article, passed away at 62. He did a lot of good for his readers. He wrote 1,000 personal finance columns in the journal. He passed away at 62, died in Philadelphia, and had a rare form of lung cancer. Between 94 and 08, he wrote 1,009 columns on investing, financial planning, and life. He was one of the first, and this is why I think it's great to remember this. He was one of the very first to argue for index funds. Keep in mind, in the 1990s, the professional investors, this article reads, derided index funds as inferior and a guarantee of mediocrity. Jonathan Clements, who passed away, praised them as a sure way to minimize the risk of underperforming the market. So he was telling people when he was a John the Baptist in the desert type, no one was believing him. He was right. He was right. So he had some great quips, some one-liners. He has a great, investing simple is what we say. He said, what should investors do today? He wrote, and nothing in the news is actually new. A column published in 03, the answer, the same thing they should have done last year and the year before that and the year before that. Nothing. Keep it simple. Keep it simple. So we stand on the shoulders of folks like Jonathan Clements, who at the time had a very difficult job of trying to convince us that index funds were the way to go. And I think it's a great reminder When I talk to investors today, I feel this way about myself. We almost have this presupposition that, of course, investing should be this way. Of course, a click of the button at no commissions for a free product is normative. That's the reality for investors today because of the John Bogles, because of the Jonathan Clements who advertised what John Bogle was doing. Investing is easy, it's free, it's simple. You got to know what you're doing. It's never been so good. It's never, and it used to be very difficult. You heard the price in 1970 or 1981 for the Vanguard Fund, 0.43%, 10 times what it is today, and how hard it would have been to actually access that. Just today, this very day, I was helping a client purchase on the Fidelity platform products that were Vanguard products on the Fidelity platform, ETFs. Those ETFs are basically free. The trades were free. The cost to have the Fidelity platform, free, all of it free. I thought, the whole no free lunch thing, of course, you've got to, they're trying to cross-sell every which way now. But if you know what you're doing, there has never been a better time to invest. We have lots of troubles in this world, to be sure. But when folks lament to me about how bad the world is, I typically will just posit this thought. I'll say, you tell me what year you'd like to go back and sit in a dentist chair. I'll listen. No one wants to go back for the dentistry. 1900? 1800? Nope. What about 1950? Nope. Everyone likes their dentistry modern and up to date. It's the same way with investing. It was not better to invest in the past. Now, of course, maybe you could look at price to earnings ratios, what it costs, but there has never been a better time to be an individual investor than right now. You just got to remember to keep your costs low, your investing simple, and your time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.